It's pretty incredible for an industry that prides itself on innovation and technology, just how slow most of us are to adopt these new tools. You are building a platform to be able to support that growth. One of the mindset differences is when you're solving a problem, it shouldn't be just to get the answer to that problem. It should be with one eye towards the future, because whatever is being asked of you right then, there's a very high probability that that problem or that issue is going to arise numerous times. And so instead of spending the time to manually solve that, how do we think about putting a system in place that can address that need over and over going forward? Because ultimately, the only way that you're going to be able to scale, it's not through headcount. One of the areas you can be supportive of to your team as they're coming into pitch to a VC is it certainly is okay to be ambitious, but you should be realistic about expectations. We see quite a few pitch decks that have astronomical projections based on unsupportable data. And so I think just having a realistic grounding in terms of the numbers.
Welcome to Turpentine Finance, a podcast where we talk with top founders and finance leaders about what it takes to architect success. Our guests speak candidly about big business inflections, market curveballs, and how they approach decision-making so that you have the tactics and mental models for when the pressure is on. I'm your host, Sasha Orloff, founder, CEO, and self-professed finance nerd. You ready? Let's dive in. I am excited for the show for many reasons, but I think a lot of it has to do with this guest, of course. So while many of us have raised capital from venture capitalists, I wonder if you ever wonder about what it's like to be the CFO of an actual venture capital fund. There's, something quite sexy about billions of dollars under management, but let's learn a little bit more about what goes on behind the scenes. So joining me today is Mark Allen, the CFO of General Catalyst. And Mark has an amazing background, undergrad MBA in business, senior associate at PwC, Summit Partners, Audex Group, and for the last 10 years, he has helped scale General Catalyst from a comparatively small fund in Cambridge to a global powerhouse managing billions of dollars with hundreds of employees, I understand. So Mark, let's dive in. Welcome to the show.
Well, thanks for having me, Sasha.
All right. Let's start with your journey. What was your journey to become the CFO of General Catalyst? How do you actually land the job of CFO of such a stellar fund?
Yeah, that's a good question. It actually started right out of college where, like many young folks, without knowing which industry they want to go. And I started in public accounting. And within a year or so, I landed in their alternative investments group where I got exposure to venture capital and private equity for the first time. And it was really something that was interesting to me. And then by chance, a partner at PwC grabbed me because there was this new startup venture capital fund in Harvard Square, Cambridge called General Catalyst. And he said, we need to head up there and pitch them on their audit because they needed audit work done in their first year. And so we hopped in a cab. This was before Uber. We went up there and I got to meet David and Joel, the founders of the firm. I was a 21-year-old kid who didn't know much about anything. And I also met Bill Fitzgerald, who at the time, Bill was the CFO and wore many hats because the firm was just in its infancy stage. But I recall those meetings. I was very interested in what they were doing because they had no track record, but there was this contagious energy from the folks that I met. And so I just recall that vividly. As you mentioned in the intro, I then went and spent 10 years in industry. And so after that 10-year period, the phone rang. It was Bill. He was looking to build out the finance team at GC, and he wanted to know if I wanted to have dinner. And so I met with him that night and then probably made what was the easiest decision in my career, which was to go join GC a little over 10 years ago.
I just want to clarify a point. You said there was a infectious energy at a venture capital fund and not at a public auditing firm?
Yeah, could you believe it? Yeah. It was, not to interrupt you there, but yeah, the quality of people, 10 years ago and even to this day, their ability to attract just great, high quality individuals, I think is what is one of the main differentiators that we have at GC amongst some of our peer group.
Going back to that dinner, there was that moment. And what was the thing that got you the most excited?
Prior to that dinner, I had spent about 7 years on the credit side of the cap structure. And, hitting a home run meant not losing capital and getting repaid, your principal. And so there was this capped potential in the work that you were doing. And then I just recall going back to GC in my early days, they hadn't had too many home runs, but certainly there were some. Kayak was hatched out of the offices. HubSpot was an early win, and just the ability to work with a group of people that were looking for the next big idea. Right, you had to be around big thinkers, and I knew GC had many of those individuals when I joined the firm back in 2013.
What was the first thing you had to do? Like they hired you to solve, I'm guessing, a problem. What was the first thing that you did when you came in?
The first thing I did, and I don't know if this was initiation, but I remember being immediately sent down to David Fialco's office. And I remember spending an hour with David. And for those of you that have met him, he's just one of the great VCs and a big mind, but just also a big personality. And I can't remember what the task was in particular, but I believe it was around some sort of cost management across the two offices.
Got it. They're not too dissimilar to a finance role in a lot of companies. Just we'll talk about a little bit later. The business model of a VC is different. Actually, let's dive in right now. All right. So at a high level, the VC business model, probably at its simplest core, and you should correct me if I'm wrong, is you invest money, which you raise from limited partners, and you give them to promising private equity companies, which we sometimes call high risk investing, and create hopefully outsized return for your investors. From your perspective, what are some of the non-obvious intricacies outside of that limited definition?
Yeah, and I think you nailed it. Like the VC model, it's not over complex. Like most of the companies, greater than 50% of the investments that we make, we won't recover our full capital. But the VC model is not about the investments that don't make it, right? It's all about your winners. This is the power law, and it is fully in effect across VC funds. You pick good companies, you're going to have a good fund. If you're able to pick elite companies, and we're talking about the Facebooks, the Ubers, the Stripes of the world, then you're going to have an elite fund. And that's just how the sort of the VC model works. Some of the intricacies that are a little bit less obvious, and certainly from the mind of a CFO, is there's a lot of work that we put in around portfolio construction. And we do this because we have to execute the fund in a manner consistent with the guidelines that we set forth in our LPA agreements. And some of these examples include investment mix. And so we look at the parameters of how much capital we can invest in certain geographical jurisdictions or across certain industries. We look at stage breakouts. We want to make sure that the appropriate mix and diversification syncs to what we told our LPs. And then from my standpoint, probably the most difficult part of managing a fund is appropriately managing the capital deployment to ensure that we have the necessary reserves in a given fund to support the needs of our portfolio companies. Because properly estimating the future capital needs of our companies and then staying disciplined on deploying that capital is one of the biggest challenges that us fund managers face.
Oh, I have so many questions, but let's think about that. How do you do that? Like, do you have an FP&A division? Is there literally an FP&A thing in the fund where you're trying to predict capital needs and reserves?
Yeah, it's much more art than science. And I can tell you that over my 10 years, we've started to really build that muscle to become a little bit more sophisticated in how we project capital. At the end of the day, you're always going to need more capital than you think you're going to need. And there's a whole bunch of factors for that we won't go into today. But what we're trying to do to better enhance is we're working much closer with our investment leads as they write that first check, that first Series A check, is to go through that thought process around how much capital may be needed to see this company endure in the long run. And so we look for different measures. If they hit this threshold, are we going to want to lead the Series B? Or is it something that we may look to just do pro rata? And so we're looking at a bunch of different probability models, and we're trying to really hold folks accountable to an honest assessment of how much capital may be needed over the long run.
And I'm sure we'll get into this later, but just to make sure we're clarifying for all the users that aren't super familiar with all these terms, how reserves and power law fit together is back to your first comment. Correct me if I'm wrong. That your power law means that these, what you'd call these elite companies. These are the ones that are going to be the standout performance. And holding reserves allows you to make sure you're balancing the capital per your fund in the places that are going to have high return exits, which likely are the companies doing well versus otherwise. Is that roughly right? What would you correct?
That is roughly correct. Yeah. And when we talk about follow-on reserve capital, there's many reasons why you would need to support a company. If we think about companies that are performing well and moving up and to the right, you're going to want to maintain your ownership. And so as they raise further rounds of capital, you're going to want to do your pro rata or more to maintain that ownership. There's also other scenarios, and we've seen this, unfortunately, in the last 12 to 24 months, where companies are raising capital and you need to support or participate at your pro rata level to protect your existing preferences of the prior round. And so there's many, many reasons why you need that capital available. And so that's why it's critically important that you properly project that.
Got it. And so let's dive into one of the other comments before. You talked a little bit about some of the complexities of a VC fund and maybe investment mix or geographical jurisdictions. Can you talk a little bit more about what that means?
Yeah, certainly. In our older funds, where we raised one fund or one pool of capital, we would do our early stage investing. So that would be our seed investing, our Series A. We would also do our B and C, our later stage growth investing, all from the same pool of capital. And so that comment was based more on our older funds, where we have one pool of capital, but many strategies investing from that one pool. Some of our newer fund cycles break out based on stage. And so we have less need to track that, but that's what I meant by ensuring the proper mix across stages.
And geographical, is it correct to think, well, like some geographies of the world might not have either the same capital requirements or they have more? Is it playing in there as a competitive advantage in geographies, or is it like a company in Honduras might have a different capital need than a company in China, just given the size of the market, depending on the industry?
Yeah, the geographical breakdown has a couple components to it. And really what it comes down to is we need to make sure that we're investing the capital in jurisdictions that we tell our LPs we're going to be doing so. And so, for example, we may raise a fund and say that the capital will be deployed primarily domestic here in the United States, with a 20 to 30% bucket allocation for non-US investments. Over the last couple of fund cycles, we've gotten a little bit more specific around the regions. We're calling out a specific amount or limitation in Europe, investing in other jurisdictions like India and similar. Really, what we're doing there is just ensuring that if we've put a 20% cap on a specific jurisdiction, that we do not exceed those limitations.
So probably a big part of the job is sort of traditional accounting and data cleansing work. Like you have to track and make sure you're hitting either covenants or thresholds or commitments, and you're deploying this the right way, and you're being really intentional about it. The data quality is important, even at a VC fund.
That's right. That's right. That's why we have people in charge of sort of fund composition for each fund that we have, so that during that 3 to 4 year life cycle, when we're deploying capital for any given fund, we have full visibility into the different thresholds that we have set.
This probably comes into a bit of the play about that quarterly request we all get, if not more often, asking us to provide information to our investors. And how does that, is this one of the primary reasons it's an input, or are there other reasons why we're doing these quarterly reports?
One of the most critical functions that the CFO has within any VC fund is, at least for GC, right? We have hundreds of portfolio companies, and it is critically important that we have line of sight into how well those companies are performing. And we need that for a whole host of reasons, but primarily because we have to assess valuation of each and every one of those companies on a quarterly basis. And so it's important that we understand how well the companies are doing relative to budget, line of sight into cash burn, when will they next need to raise capital, and other KPIs that are specific for every portfolio company.
Hey, we'll get back to the conversation in a moment after a word from our sponsors. There's a world where your CRM is powerful, easily configured, and deeply intuitive. Attio makes that a reality. Attio is a radically new CRM built specifically for the new era of companies. It's flexible, easily configures to your unique data structures, and works for any go-to-market motion from self-serve to sales-led. Attio automatically enriches your contacts, syncs your emails and calendar, lets you create powerful reports, and quickly build Zapier-style automations. The next era of companies deserves more than a one-size-fits-all CRM with an outdated UX. Join 11 Labs, Replicate, Modal, and more. Try Attio instantly at attio.com. That's attio.com. I just want to reiterate that point because I think sometimes the perception can be for an acting CFO of a portfolio company or a CEO or a founder that there isn't a lot of value add to this reporting. And it's kind of, some might say it could be cumbersome and hard. But when you think about it through the lens of you're going to try and build an elite, enduring company, and that inherently is going to require capital, that if you're not doing this in a disciplined way and it's not accurate, your fund can't support you in the best way that they have resources to potentially support you at that time, which is capital.
Yeah, that's correct. And that's why it's critical that we have not only our investment lead speaking with the founders directly with some regular cadence, hopefully monthly, but at least quarterly, to then supplement that with the direct feed from our portfolio companies so that we have line of sight into the metrics. Because we have to go through an audit and our auditors need to see these metrics as well. And so there's many reasons for it. But yes, it's a bit of a pain point. I think the industry has made significant progress in trying to streamline the effort needed. We're trying to standardize what those reports look like. We're trying to make it as seamless as possible for our founders and our founders' CFOs to provide that data to us.
Fascinating, and also actually not expected. I don't know why I actually was so surprised at this. Like there's such I think a revolution right now in tools for the office of a CFO. It would make sense that that also applies to the role of a CFO at a VC fund as well. I'm sure the role has shifted a bunch. What are some of the tools that you use to help accomplish your job along the way, whether it's pattern, risk analysis, opportunities, tracking, like you said, organizing and synthesizing this data?
When I reflect back on just the last 4 to 6 years, the enhancements that we've made in technology is just incredible. And I think before we go into the handful of tools that we use today, it's pretty incredible for an industry that prides itself on innovation and technology, just how slow most of us are to adopt these new tools. The first 10 to 15 years, we were built on Excel. And I don't think we are any different than most of our peer groups. Excel was a tool that could do everything. It had full transparency. You could check the formulas. And so there was zero reason to move off of it, even as these tools became available. And I think when you look at the last 4 to 6 years, we actually now have done a 180. We are now actually challenging on things that we still do in Excel, whether we should be doing them in Excel, which is just an incredible mindset shift that we've had at GC. When we look at the tools that we use, and I've written down a handful just to kind of summarize, around our legal documents. So we have a software that we utilize that scrubs all of the legal docs that we have for all of our portfolio companies. So it allows us to standardize the data and summarize it. We have a cap table service that all of our portfolio companies subscribe to. And so we have line of sight into cap table changes as there's option pool refreshes or subsequent round of financings. We have immediate line of sight into our ownership. I mentioned earlier the software that we use to collect data from all of our portfolio companies. That has created significant efficiencies across the industry there. We've actually dipped our toe in the water around AI. And I think the tool that we have found the most success with is around DDQs. And so when we are raising capital and we're getting due diligence questionnaires from new LPs, most of these investors ask the same questions, but they do it just a little bit differently in their wording. And this tool is able to go through their questions and identify keywords and then reference to our response bank how we have responded to those types of questions in the past, and it pre-populates that DDQ. So now our folks, instead of spending time pre-populating it, they're just going through and making sure that the responses are appropriate, which tremendous time savings on our own. And then, of course, we have data extraction and comparison tools. We have data analytics and visualization tools that we're using on high volume data requests. We're also working with developers. When there's a need that we have and we can't find the tool for it, we're engaging with these third-party developers to build us our solution. And then, probably most importantly, to wrap it all together, because we have so many different data services, we're trying to figure out how to get them all to speak to one another. And so there's a massive effort and a lot of resources being deployed right now to build this API connectivity. So in our dream world, we have all of these sources talking to one another so that we can create very high value output reports.
All right. Sounds like there's a founder out there with a new opportunity that has emerged along the way. I'm a big fan of sort of AI assisted human in the middle stuff. And we do that a lot. And I appreciate that also as a founder as well. Any specific companies that you want to give shout outs to that are helping make your life easier aside from Microsoft Excel?
We've got a couple. We've been using Grammarly. I think a lot of folks use that in their day-to-day.
Over the course of time, there's been changes and investments and improvements to like software, which we just talked about. But GC itself has scaled over from, I would say, a somewhat well-known but East Coast fund to like a global powerhouse. What are some of the major inflection points that have happened along the way, either from GC or from your viewpoint as a CFO? You've been there for a while now.
First off, I have not heard anyone refer to us as a global powerhouse. I appreciate the compliment. We like to think that we're building an enduring firm, but your point is well taken. From the lens of a CFO, for me, it starts and it ends with fund performance. Like, if we are not producing consistent tier funds, then none of this growth that we've seen in the last, call it 5 to 8 years, would be possible. And I truly believe that, right? And so kudos to the entire team. Our portfolio has performed fairly well and has delivered returns to our LPs. And that is critically important. When I look at other inflection points, there are two that stand out to me. One is our geographic expansion. And you've mentioned a couple of times, we were East Coast, Cambridge-based venture capital firm. We did what we did fairly well, but we had some limitations. And I think looking back to 2010, the firm and Hemant Taneja made the decision to move HT to the West Coast. And he has done just an extraordinary job establishing our presence on the West Coast, amongst a peer group that had territory in the Valley there. And then just a couple of years later, we opened up in New York. And I think, being in those locations, what we call centers of innovation, has allowed us the ability to be involved in a number of very high profile and successful companies. A few that come to mind are, Stripe and Snap, Gusto, Livongo, Warby Parker in New York, just to name a few. And so I think being in these locations has really allowed the firm to prosper in a meaningful way. And then the other point, inflection point, as I look at it, you grow because your investors have faith in you. And the way we've been able to grow, and this has been highly intentional by our investor relations team, we've been able to attract and get access to high quality, very large pools of capital for the firm. And so, with that comes challenges on the back office side, because we have to support. This will be of no surprise to anyone, but when you take large investments from these large institutional investors, they usually come with quite a list of reporting requirements, which, that's what my team and our team at GC do, is we focus and we prioritize making sure we have the resources to meet those needs.
Over the course of that 10-year or so period as well, you guys went from managing, I think what I found publicly, and you can either correct me or just go along with the flow, like hundreds of millions of dollars to now billions of dollars under management. What are some of the major changes involved when those things happen?
Yeah, I mean, there's lots of changes. I think, first and foremost, as you are building a platform to be able to support that growth, one of the mindset difference is when you're solving a problem, it shouldn't be just to get the answer to that problem. It should be with one eye towards the future, because whatever is being asked of you right then, there's a very high probability that that problem or that issue is going to arise numerous times. And so instead of spending the time to manually solve that, how do we think about putting a system in place that can address that need over and over going forward? Because ultimately, the only way that you're going to be able to scale, it's not through headcount. We have been able to attract, really high quality individuals, but it's having the right people in those seats that are driving the technology changes. That more than anything is what has allowed us to be successful as we've scaled. The numbers you provided were roughly close, so we'll go with it.
How many people, can you share, how many people were at GC when you first started, and how many people are there now?
Yeah, we were 30 when I started 10 years ago, and your rough math of a couple hundred, I think, is directionally accurate today.
So I'm also guessing over the course of that time, there might have been, maybe a couple stressful moments or decisions that needed to be made. Can you share a big stressful time or decision that you had to make that ended up obviously hopefully being great for the firm?
Yeah, the first one, and I don't know how great it was for the firm, but, certainly it passes the big and the stressful part of your question. We just passed the 1 year anniversary of the events of Silicon Valley Bank. And as I reflect back on what a critical point that was for General Catalyst, not only GC, but also our entire industry. You know, Thinking back to that week, you had the run on the bank, you had paranoia setting in across the entire industry. And I think amidst all of that, the leadership at GC, this was led by Hemant and Ken Chenault, they convened the entire team and tried to determine what the best course of action was for General Catalyst. And knowing that many of our portfolio companies banked exclusively with SVB, which means that they were going to have payroll issues amongst many other issues. And ultimately, we made the decision that to not only show support for the bank, right, but to try to take a leadership position in the industry and gather support from many of our peers in doing so. And I think ultimately, while the story didn't end well for SVB, reflecting back on those events, I am proud of how we as a firm took a leadership role in trying to do what we could to support the bank, given its importance in the venture industry. And so while the core SVB bank doesn't exist in its form today, they do have a fund banking team which provides capital, facilities, and other services to many of us VCs and PE shops in the industry, and that business is thriving. So maybe that's the great outcome.
We talked with the CEO of Mercury about this particular moment, and we went pretty deep. And obviously that had a big impact on Mercury's business. As a CFO, I'm assuming banking with Silicon Valley Bank, where there's a lot of money and, like you said, capital call and other things, along with portfolio companies. I know I was stressed out during that time. We banked with SVB, still do, and that was just no stress moment. Can you shed some light on like what's going through your mind the moment you hear the news as the CFO of a multi-billion-dollar fund?
Yeah, I can tell you in all my years doing this, I have never felt more conflicted than I did in that moment, because first and foremost, I have a fiduciary responsibility to our investors' capital. That first and foremost. You also knew that if you pulled and contributed to the run on the bank, then you were making certain that the company was going to fail. And I think there's a little bit of gray area in there. And that's why having the support of the leadership team at GC was great, because I didn't have to make that decision. It never felt like that was on my shoulders. And the team at GC did a great job there. But yeah, thinking through that moment, that was challenging. And fortunately, we didn't lose a dollar. All of our portfolio companies were fine. There was a couple of days there where, we were scrambling to make sure that payroll was going to get met, but everything worked out in the end. And I think we all, as an industry, learned quite a bit on coming through that. And not so much of what went wrong at SVB that caused that, but just thinking about our banking relationships, right? The need to diversify across multiple banking relationships, the need to have multiple bank accounts open in case there was this doomsday scenario where you had to move and act quick. managing and minimizing cash balances, which we've always done historically, but the importance of that should something go wrong, to make sure that you're utilizing these lines of credit and not sitting on sizable cash balances just to reduce risk there. So now looking back on it, it was a challenging time, but I think we all learned quite a bit.
Hey, we'll get back to the conversation in a moment after a word from our sponsors.
Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at ericaturpentine.co. That's ERIK at turpentine.co, and let's partner together.
One of the things that kind of stands out to me is a consistent theme we hear on the podcast about the alignment of the finance team and leadership. Because when moments like this happen, there are big, scary decisions, sometimes the most important, critical decisions for the success of a company. Anything that you can share or advice for the CFOs out there on how you build trust with your leadership for moments like these, and then any insight about how do you have these conversations? Because as you said, you're conflicted and the leadership wants to do one thing, there's real consequences. How do you just even start a conversation like that? Because it's an important conversation to have. There's a lot of CFOs out there who might not have ever had to go through that yet and would want to look to this for learnings.
You did touch upon the topic of trust, right? And in that moment isn't the time to build trust, right? The trust has to be built up over time. And there should always be that connection point to, and I hate the term back office, but it's a term that we use, but between finance and a lot of the supporting roles within an organization to leadership. And I think, no firm is perfect at doing this, but I think the tone is set at the top. And I mentioned Bill Fitzgerald's name earlier. He was, with the firm for 18, 19 years and just did an incredible job of making sure that it wasn't investment team and support, that it truly was one connected unit, and there was a communication line between the two. And I think that is critical, because in those moments, as you mentioned, right, you need to make sure that you have the support of the leadership of the organization, because those are just not moments you want to go at alone. And I think doing it the way we did was critical.
And so what do you view the role of a CFO in those discussions?
I think the role of the CFO, ultimately, when it comes down to, if we take the SVB discussion in particular, the CFO is likely the most informed individual as it relates to the whereabouts of the capital that we have, what the risk looks like should various scenarios play out. And so in those discussions, the CFO should very much come to the table prepared to provide a recommendation, knowing that ultimately, the ultimate decision, they'll be part of that decision, but they're going to want to seek input from others within the industry, within the organization, that likely have different constituents and different perspectives on what outcomes may look like.
And is this something where, the headline hits? There's rumors, and then there's the day. Are you facilitate, like, hey, we should talk about this, and here's like what's going on? Are we waiting? Are you preparing? Go up to some. There was 3 or 4 days. It was speculation for a while. There were 3 or 4 days, and then the Friday morning, the reality hit, which is pretty atypical for a work week. It's usually done over a weekend, but obviously this was an extraneous situation. How are you initiating these conversations? How did these go?
Yeah, I can tell you in this case, there was no need for me to initiate, because word traveled as quickly as it did. It's funny, just reflecting back that Wednesday night, because you mentioned 3 days. I don't think it was quite 3. I think it was a day and a half to 2. I was out at a ball game, and at halftime, my cell phone started blowing up. and it was questions about the bank and the recent filing that they had. And I remember leaving the game at halftime because, people are talking, there's something going on. And the next morning, I remember there was a meeting that we had pre-scheduled with folks from SVB where we tried to dig in a little bit on what we were reading in the filings. But at that time, there was already communication within the firm and then across firms because the CFOs were calling CFOs and everyone was trying to understand what everyone else was going to do.
And so it brings up a point that you made earlier about really the importance of the relationship. How do you then take that lesson to what you do differently today?
Yeah, that's a good question. I don't know what changes. I mean, we talked about more tactical changes, right? Diversifying banks, but in terms of communication with leadership, I think just being able to draw upon those experiences. We all hope that you don't find yourself in that situation very often, right? Like these are big events that hopefully happen every 10 years or less. But just knowing that you've gone through that, you can default back to that and you know that those channels of communication are going to be open and folks are going to be there to support you through those times. I think that's what I take from that incident more than anything.
Over the last 10 years, we asked what has changed and what were some moments. That was a stressful one. Any more exciting or fun ones that you can recall that you were part of the job that are more fun?
Yeah, and I'm not sure if it's fun, but it's changed the industry. I look at the pandemic and I look at the decisions that we made because the way we work today is very different than the way we worked 4 years ago. And just thinking back to that dreadful March 4 years ago, and I do have to give credit to John on our IT side. On the first day of employment at GC, you get fully set up to work with all the equipment that you need in support to work from home. And so when we were forced into a remote nature, we hit the ground running. And for the most part, we had very few hiccups. Certainly no one thought that it was going to be permanent. Like we thought this was going to be a week or two. But looking at the big decision that I think GC has made here, and in particular for our finance team, and from what I can tell, this is different than our peers. We're still remote first. We're not mandating that people are back in the office 3 to 4 days a week. I know some of our peers are 5 days a week. We've chosen to maintain just a day or two a week in the office, but we have made some changes. When we are in the office, we allow ourselves to work differently. And what does that mean? It means less efficient. It means more team meetings, more learning sessions. We collaborate with one another more. We find ways to bond with our newer team members, right? And then we go home the rest of the week and we're more efficient because we don't have those distractions. And we've been doing this now for a couple of years and it seems to work. And you look at some of the added benefits, it's allowed some of our younger team members to access home ownership in the areas further away from some of these larger cities. And so, time will tell if this is the right decision or not, but listening to our people, understanding their needs during these times, I hope will pay off for us in the long run and to allow us to continue to attract and more importantly, retain our best talent across the organization.
Yeah, I remember the first time I raised venture capital in my first startup, I was literally driving up and down Sand Hill Road from meeting to meeting. And the word I think in the pandemic that really has come top of mind is this efficiency thing. It's like, yes, I can take way more meetings sitting here, clicking end call, start new call along the way. But it's less of building a relationship and a rapport, which I find is a bit more enjoyable when working with investors. And I've found the same thing in our company offsites. We just had our company offsite last week and we went to Jackson Hole, and it used to be a hardcore, like, we're together, let's finally debate and discuss everything. And we do that still, but we also mixed in a lot more fun and bonding because it's hard to have those opportunities to, like, back to the point, to build trust. And the moments that you need trust, it's hard to do in an artificial 30-minute screen once a week. You have to have that maybe extra beer sometimes, or fall into the snow, in our case, in the snowshoe, and need your team to help pick you up and have those longer discussions and dinners. Cool. This has been like really fascinating, interesting. I know we went on a couple tangents just because that's my personal curiosity. As we start to sort of think about towards the end, what are some of the biggest misconceptions about being a CFO of a VC fund?
The role of a CFO of a VC fund, it's really two jobs because you're the CFO of the fund, right? But you're also the CFO of the firm. And I think that is a bit of a misconception across the way. So when you look at the two roles, I don't want to make it in any way seem like I have more responsibility than any other CFO. In fact, I have a great team at GC that's led by some incredibly talented people that oversee our funds, our management company, our tax efforts, our portfolio efforts, and the list goes on and on. But really, when you look at the CFO of a VC fund, it's investor facing. And so every quarter, our team is responsible for valuing hundreds of portfolio companies. We then have to aggregate those results for each fund and deliver those quarterly reports to our investors on a timely basis. And then, of course, we have all the tax work and tax estimates and K1s and everything else we have to do. So I think that's probably, big misconception is it's not just a traditional CFO role, but you also have an LP facing responsibility that is quite time consuming.
Do you guys have board meetings? Does the operating company of General Cast have a board meeting the way that we have board meetings as companies?
We do have executive committee meetings that do meet, but a little bit different, but similar in terms of what gets accomplished. Yes.
Any advice that you can give as the CFO of General Catalyst to CFOs coming in to pitch for money?
Yeah, sure. I think as the CFO of a startup, of supporting your founders, I think one of the areas you can be supportive of to your team as they're coming in to pitch to a VC, given that you are likely the provider of a lot of the estimates that are found in those board decks, is it certainly is okay to be ambitious, but you should be realistic about expectations. We see quite a few pitch decks that have astronomical projections based on unsupportable data. And so I think just having a realistic grounding in terms of the numbers, again, it's okay to have ambition, but just be able to support in a meaningful way those estimates.
Awesome. And be prepared for your ongoing reporting because it can only help you in the moments that you need. Awesome, Mark. Thank you so much. Amazing. Any closing or final thoughts that you want to share?
No, this has been great. Thank you for having me on. I guess my only closing comment would be if anyone's out there looking to raise capital, we'd love to hear from you at GC. You can find us online. And thanks for having me.
Awesome. Thanks for coming. That was awesome. Thank you. Thanks for tuning in to Turpentine Finance. Share it with your executive team, direct reports, friends, and family. And if you want to support the show, the best ways are to leave a review wherever you're listening and subscribe. Turpentine Finance is part of Turpentine, the podcast network behind Moment of Zen, Turpentine VC, Age of Miracles, and more. Shows for experts by experts in tech.